What's going on? Steve here with IBC Global. In today's video, we are going to look at a case study of an actual policy that was started back in 2019. Now, this individual had an original plan of funding the policy only for 4 years and then stopping altogether. We're going to look at the original illustration. However, as time has passed, he's paid more into the policy than what he has originally planned, and he's funded it for more than 4 years. He's made 5 payments already, and he's considering adding at least another 2 payments. So this is a really nice case study to demonstrate what a policy looks like if I plan to fund a policy with a certain dollar amount and for a certain period of time, but then things go really well and I keep adding more money. A lot of times we'll look at case studies that demonstrate the opposite. What does it look like if you have a plan to fund a policy for a very long period of time and with a lot of money, but then life happens and you have to stop early or reduce the funding amount? Those are great case studies to see, but today will be a case study demonstrating just the opposite. And if you're interested in learning more about whole life insurance and seeing policies like the one we're about to see in this video, you can check out our website, ibcglobalinc.com. Let's get on into it and have some fun, shall we? So he planned to take out a whole life insurance policy and fund it for 4 years. The funding amount was $100,000 per year. So it's a total dollar input of $400,000 over that 4-year period. You'll see that he has funded more than planned. You'll see numbers that are not super clean, but we'll go through exactly why the numbers are what they are as we go through it. So 2019 is when he started the policy. That's when he made his first payment. Then 2020, 2021, and 2022. At that point in time, his plan was to fund how much money? $400,000 total. Let's look at the original illustration, shall we? So this is back from 2019. We can see that it is based on the 2019 dividend scale. He started at age 44. Here's his total funding right here, $100,000 per year. So there's a lot going on in this illustration, but when we look at it, if I'm interested in where my money is going, the number columns, there's 2 columns that show that. The net premium column and the net after-tax outlay column. Those represent the exact same thing in this illustration. The amount we see is $100,000 per year for 4 years, and then after that, 0 every single year. The column immediately to the right of that, cumulative net after-tax outlay, shows us total payments over time. So after $400,000, the plan was to never pay another penny into it, with the option to add if he is comfortable with it and wants to keep on plowing money in, which we'll see that in a minute. But there's the original illustration. Now, when we look at the cash value on the far right and the death benefit, what do you notice here? Cash value, first year, just about 88%, $88,000 and change, and the break-even point is between years 3 and 4. By year 3, he's paid in $300,000. His cash value is $295, so $5,000 less than what he's paid in. And then by year 4, his cash value is $405, where he's paid in $400,000. So he's paid in $400, and he's got about $5,000 more than what he's paid in. So that's why I mentioned that break-even point, which is when he gets his money back, is between years 3 and 4 in this particular example. And this is what was illustrated back in 2019. So if I'm watching this video today, and I'm going to look at an actual policy now from 2019 up until almost the end of 2023, the first question I would ask is, if he has max funded the policy with about $100,000 per year, has it broken even between years 3 and 4? Or did the insurance company overpromise and then underdeliver? It's important to have awareness and see how actual policies work. So let's do exactly that. Before we get into that, what I want to mention really quick is while he's got $100K per year going in, here's his minimum premium, $10,000. Here's the cost of his term rider. What he's billed for each year is right around $12,000, but he can fund up to $100K per year, a little bit more actually. So it's set up to be very flexible, where he doesn't feel like he's on the hook to write a check for $100,000 every single year. So what we've got here, the original plan, which is what we just looked at, funding for 4 years, but then in 2023, he's added money again. What he was originally interested in was a safe place to put his money where he could access the cash value, specifically through policy loans. He was attracted to that because when he borrows against his cash value, his entire cash value keeps on compounding. There's no lost opportunity cost. He was very attracted to that. And the tax benefits are very appealing and benefit him a lot in his particular case because him and his wife do well financially and they are in a high income tax bracket. So let's look at the policy performance. We've got here, he likes the cash value growth. We're going to see the actual cash value growth right now. So we've got the actual values on Excel. We pulled these from the annual statement, and he is presently in policy year 5. So what we've got here, I'm going to walk through this one column at a time. So again, this is what has actually happened so far. Year 1, this was back in 2019. That's when he started the policy. Here's how much he funded the policy with, 104,300. Where this number comes from, guess what? That's his MEC limit, approximate. It might be a couple bucks higher than that, but that's right around his annual MEC limit. He could add a little bit more than $100,000 per year. So he did exactly that. So his total first year funding amount, $104,000 and change. In blue is how much he's funding each year, annual funding. Then to the right, we've got total funding. This will tally up his total payments over the years. So year 1, he's paid at 104. That's why the total funding is 104. Cash value, $92,000 and change. Then we've got the net death benefit at $2.25 million. Now, looking at the cash value and annual funding. So let's clear some space here. I'll clear the drawings. So year 1, this is you. You fund just over $100,000, 104, and you have $92,000 in cash value. When we compare these two columns, the annual funding and cash value, this will help us see the cash value growth. So the first year, how much did you lose because you have less than what you paid in? If we're purely focused on the cash value, about $12,000. The cash value gain is going to compare the cash value and total funding. That first year should be in red. It's a negative there. But the first year, we have a $12,000 loss, simply looking at how much I paid into the policy and what I have in cash value. If I look at the next year, he funded how much? $99,000 and change. So his total funding is $203,600. What was the original plan by year 2? To fund how much? $200,000 at $100K per year. But looking at year 2, let's do this. He paid in $99 and change. Cash value is $194. Cash value growth is $2,601. Here's how we came up with that $2,601. Year 1, you're at $92,224. If you add $100,000 to that, just a clean $100K, what would it be the next year? It'd be $192. What is it? It's $194,125. And he actually added a little bit less than $100K. So what the cash value growth is showing here is that he got his $99,300 back plus another $2,601 from the insurance company in that particular year. That's why we've got positive cash value growth in year 2. Now, if we look at the cash value gain, we're still negative. So why is your growth positive in year 2, but your gain is still negative? The reason why is because the gain looks at the total funding column. So you have funded out of pocket a total of $203,600. Your total cash value is $194,125. There's a difference there of $94,75. So the cash value gain will always compare these two columns. And if we break even between years 3 and 4, once we break even, that's when the gain should no longer be a loss. We should actually see a gain. So year 3, look at this. Funds 108,300. How did he do that? Because his MEC limit is just over $104,000. How did he pay 108? And his policy is not a MEC. How he did it is because year 2, he paid in 99 and change. So he could have paid in, call it another $5,000 that year, but he didn't. That unused MEC space, the unused 5K, rolled over to year 3, and he made up for lost time. That's how he did that. So unused MEC space does roll over year to year, and some companies do allow you to make catch-up payments when you're adding more into PUAs. You're making up for lost time in that particular case, which is nice. So year 3, he adds 108. He gets the 108 back, plus another $5,052. Year 4, adds 101 and change. We see that the cash value is now more than what he's paid into the policy. You see the positive gain there, and it's compounding. So the first 5 years, he's paid this in already. So he's funded over $500,000 into the policy, where his original plan was to do what? Fund $400,000. So what he might do is continue to add money. Now he might continue to fund up to the MEC limit. We used some round numbers here just to keep things simple. So this would be December of this year of 2023. We're shooting this video at the end of October 2023. So he could fund another 100K, which if he does that, he'll get that back, plus another $20,000 in change for that particular year. And then the total cash value at $655 compared to his total payment of $614 and change, there's a gain of almost $41,000. 6 years into it, and he's been accessing the cash value all along the way. Remember, if we do everything right, if we do things right, we can access that on a tax-free basis. If, meaning you don't trigger a modified endowment contract, cash the policy out with a gain, or any other taxable event. We've got a lot of videos and content that discuss that. Year 7, at 50 years old, he might stop. Here we've got another 40K going in, gets his total payments right around $650. We could make that $36,000 or $35,000 in change to make it a clean $650. You see what we're doing there. But regardless, we see that the policy is moving now, moving forward. And what does it look like if he doesn't add anything after that? Well, what happens? Does the cash value continue to appreciate or compound even though you're not paying anything in? The answer is yes. So just like that original illustration where we saw that he paid 0 out of pocket after 4 years, we're doing the same thing except it's 0 out of pocket after 7 years. So not paying a penny into it. If he wants to keep paying 40K, for a few more years, he can do that. But again, he doesn't have to. We're illustrating stopping funding altogether here. If he wants to keep paying 10K, the minimum premium, he can do that. But even with stopping here, we see that the compounding just keeps on keeping on. Again, the annual cash value growth. What this column is showing is the growth that he's getting from the insurance company. We're not including his payments in there. That's very important to me because when I'm looking at growth, I want to know what I got from the insurance company or institution that my money is with. I don't want to include my money going in because that's my money going in. Same thing with the total gain here. So by age 50, he'll have a gain of close to 70 grand. Year 15, gain of about 353,000. This is assuming here the dividend rate does not change. It likely will. But the actual results, if we were to look at the internal rate of return with the original illustration compared to this, they would be so close. In 2019, the dividend rate was 5.85 with this company. What happened is 2020 through 2022, the dividend rate was 5.65%. So it came down just a touch. 2023, the dividend rate started to come back up, 5.75. So we'll see what happens as time continues to pass. But it has not adjusted that much from the original illustration. So when we look at the internal rate of return, it's almost spot on. And a big reason why is because he's funded it aggressively too. So from a design standpoint, we designed it to maximize cash value, and he's followed through with exactly that. He's actually enhanced it slightly because he's added more PUAs into it than we originally planned. But the policy is performing quite nicely. We see healthy cash value growth. He does not have to pay anything else into it. He's got the tax benefits, and he can continue to access the cash value like a personal line of credit, whether he wants to continue to finance real estate, if he starts his own business, whatever he decides to do. So I hope you enjoyed this video. If you did, please let us know in the comments below or hit the thumbs up, i.e. the like button. And as always, I hope this helps. Thanks so much for watching. Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.